You can work 50 hours a week, budget your groceries, and skip the vacations, yet still feel like you're losing ground every single month. The American economic system categorizes everyone into three distinct groups: consumers, entrepreneurs, and investors. If you only participate as a consumer, your money flows entirely in one direction. You pay corporations for goods, you pay banks interest on the debt used to buy those goods, and you pay the highest tier of taxes to the government as an employee. Look at this chart comparing average consumer debt against the dollar's purchasing power. While the cost to buy everyday items steadily climbs, the debt required to afford them accelerates even faster. A high salary doesn't fix this math. Doctors and athletes go broke all the time because earning a massive paycheck simply allows them to qualify for higher levels of consumer debt. To actually accumulate wealth, you have to cross over from being strictly a consumer to becoming an investor. Today, we're going to break down the exact mathematical trade-offs required to make that jump. Because if you do not intentionally acquire assets, your lifetime of physical labor will mathematically default to funding the retirements of the people who do. The fastest way to cripple your wealth-building capacity is by using unearned future income to buy things that lose value the moment you acquire them. This usually happens through the 3 C's: cars, credit cards, and lines of credit. When deciding if a car is affordable, most people only look at the monthly payment, but a $600 lease is an agreement to pay a premium to drive a machine that has a limited lifespan and bleeds value every single month. Credit cards weaponize this exact same math. The average American household carries around $6,500 in credit card debt. When you carry that balance across multiple cards at an average APR of 25%, you're paying thousands of dollars in pure interest just to maintain the debt. If you flipped that equation and earned a 25% annual return on a $6,500 investment over 30 years, you'd have over $5 million. That compounding power is what you hand over to the bank every time you swipe without the cash to back it up. Debt is simply pulling next year's income into today and paying a steep fee for the privilege. The pressure to do this hits hardest right after a pay raise. The immediate instinct is to validate your new status by upgrading your vehicle or booking a luxury vacation on a line of credit. The trade-off for that immediate social validation is the destruction of your baseline capital. You guarantee that you will have to trade more years of your physical life just to service the debt you took on to look successful. Once you stop bleeding capital to debt, you hit the second bottleneck: trying to build wealth entirely through your W-2 paycheck. The tax code treats the money you make from your physical labor very differently than the money your assets generate. This matrix tracks 2 identical incomes. A surgeon earning $1 million faces federal, state, and FICA taxes, losing up to 50%. But an investor making a $1 million profit from capital gains caps their tax liability at 20%. Relying entirely on a salary creates a mathematical ceiling. No matter how much you charge per hour, you eventually run out of hours in the day to perform surgeries or code software. Achieving prestige through a career yields a high income, but achieving actual wealth requires separating your earnings from your physical labor. This brings us to the third hurdle: extreme risk aversion. Keeping all your capital in a traditional bank account feels secure. You see the exact same nominal balance every time you log in, avoiding the emotional roller coaster of market volatility. But protecting that exact dollar amount means surrendering its actual purchasing power. Even a high-yield savings account rarely keeps pace with the true rate of inflation over decades. You also cannot outsource this risk to the government. The current Social Security system takes your paycheck contributions to fund today's retirees. By the time you need it, those funds may be severely depleted or require heavy adjustments to remain solvent. The investor path requires taking your cash and buying assets in public markets. This means accepting that your portfolio will experience short-term losses. Even Warren Buffett loses money in down markets. To do this, you have to mentally separate your investment capital from your daily spending money. You will face anxiety when the market drops, and you will have to resist the urge to liquidate your positions in a panic. Clinging to absolute short-term safety mathematically guarantees your money will erode. you must endure managed market risk to outpace inflation. Look at this chart mapping effort versus impact across different financial profiles. Moving into the investor class requires diagnosing your specific archetype rather than following generic advice. If you are a high earner with a large salary but few assets, your pivot is halting lifestyle inflation. Next time you get a raise, route that excess capital directly into investments before you increase your spending. If you are a conservative saver sitting on heavy cash reserves out of fear, your required action is exposing excess cash to the market to beat inflation while keeping a basic emergency fund secure. And if you are a beginner, ignore the shiny objects and get-rich-quick schemes. Your entire focus must be on eliminating high-interest consumer debt, because you cannot out-invest a 25% credit card rate. Your specific behavioral friction dictates the exact systemic shift you must make to progress. Building wealth requires rigorous discipline, but relentlessly optimizing your balance sheet carries its own psychological cost. You can easily fall into the trap of sacrificing your physical health, isolating yourself, and burning out in the singular pursuit of asset accumulation. Saying no to dinners and vacations makes sense when you're fighting out of debt. But eventually, you have to reel that intensity back. Your financial health is meant to support your physical and mental well-being, not replace them. Wealth is ultimately just a tool to purchase autonomy and time. It's completely useless if you destroy the life you